it's vital to understand our purpose and roles as speculators in these interrelated markets. Although our sole intention is to make profits, we serve a far more important role, which is to provide liquidity to the wider market, and therefore providing everyone with ultimately better prices. Speculators like us trade in a broad range of asset classes, and therefore we drive movements in all of them. Financial markets that have the most impact on FX include bonds, commodities, and equities. So let's start with bonds. If you are really interested in the financial markets, you should have at least heard of a bond or have a rough idea of what they are by now. But in case you don't, a bond is simply a form of loan from a company borrowing from the market. In exchange for this investment money, the government or company will pay the loan back at a certain date, which is known as the maturity, and on top of this, they will actually pay the investors an interest to make it worth their while. This interest is also known as the coupon. Bonds are also known as fixed income securities. The amount you will receive across the loan is known in advance and guaranteed by the issuer. The coupon is paid twice a year, and then at the end of the agreement period, the investors receive their original investment back. Basically, there are two types of bonds: corporate bonds and government bonds. The most important kind being the government bond, because they are directly affected by interest rates, which ties in perfectly with forex trading. Because governments are very dependable and stable, the chance of default is very low, making bonds a great low-risk investment. They are also sold and traded on the open market, meaning that you can buy a bond and then sell it to another investor at any time before the date of maturity. The face value of the bond is the amount that the investor will get back at the end of its maturity. If the current price is more than face value, it is said to be trading at a premium, and if price is below face value, it's said to be trading at a discount. Lower coupon bonds tend to fluctuate more than higher coupon bonds when interest rate changes. Furthermore, the price of a bond that's maturing in 1 year is more predictable than one that matures in 100 years' time. So in general, the higher the maturity time, the higher the interest rate will be. Basically, this all revolves around risk. The higher the risk involved with the bond, the higher the interest will be. Moody's, Fitch, and S&P help investors rate the bond issuers so that they are able to select bonds that suit their risk tolerance. Therefore, the market pays close attention to what these agencies say. These agencies split the issuers into investment grade or junk grade status. Now, issuers with a AAA rating are the best rated ones to deal with, and anything that's a BBB and below is considered as speculative and carries much higher risk. Now, governments and their bonds that are rated as junk are not necessarily safe and therefore are required to offer a much higher yield in order to tempt investors in. Now, the most confusing part about bonds for most new traders is that there are so many different prices to measure. So I'm sure you're wondering about this, so I'm going to simplify this as much as possible so that you're able to understand how this works. Now, when you are trading, you will often hear analysts talking about something called the yield. The yield is simply the coupon amount divided by the current price of the bond. To understand this better, we'll use an example to explain this. To do this, of course, we are going to oversimplify slightly, but they'll give you a good general idea. Now imagine you buy a bond with a face value of £1,000 and a coupon for 10%. If the price stays at £1,000, then yield is simply £100 a year. However, if the price of the bond goes down by 100, the yield now increases to 12.5% because the coupon payment is basically based on the original face value of the bond. This means that you will receive £100 coupon for a £900 bond, which is obviously better than 10%. The reverse is also true when prices go up. In short, when prices go up, yields go down, and when prices go down, yields go up. So if you are in the market for buying bonds, your primary concern is a high yield. But if you are a bondholder, you want to see that price increase so that you are able to cash out for more money. As such, you are hoping for yields to fall. It is hence important to understand their relations to interest rates because they are just as important to the bond market as they are to the forex market. Now, when interest rates rise, the price of bonds in the market falls, thereby raising the yield of older bonds to bring them in line with newer bonds that are being issued with higher coupons. When interest rates fall, the prices of bonds rise, therefore lowering the yield of older bonds and bringing them in line with newer bonds being issued with lower coupons. This is why bonds are so affected by rate adjustments and the speculation of rates surrounding them.